like once every 50 to 75 years. These cycles of building debts and writing owed debts have existed for thousands of years and in some cases have been institutionalized. For example, the Old Testament describes a year of Jubilee every 50 years, in which debts were forgiven. Knowing that the debt cycle would happen on that schedule allowed everyone to act in a rational way to prepare for it. Helping you understand this debt cycle so that you are prepared for it, rather than surprised by it, is my main objective in writing this book. Ironically, the closer most people are to the blow-up, which is also when the claims outstanding are largest relative to the amount of hard money and tangible wealth there is, the riskier the situation is, but the safer people tend to feel. That is because they have held the debt and enjoyed the rewards of doing so. The longer it has been since the last blow-up, the more people's memories of it have faded, even as the risks of holding the debt rise and the rewards for holding it decline. To properly assess the risk-reward of holding the time bomb, one must remain constantly aware of the amount of debt that needs to be paid relative to the amount of hard money there is to pay it, the amount of debt payments that have to be made relative to the amount of cash out the debtors have, and the amount of interest they bring in. The long-term debt cycle in summary. For thousands of years, there have always been three types of monetary systems: Type 1, hard money; Type 2, paper money; Type 3, fiat money. Hard money is the most restrictive system because money can't be created unless the supply of the metal or other intrinsically valuable commodity, that is, the money, is increased. Money and credit are more easily created in the second type of system, so the ratio of the claims on hard money to the actual hard money held rises, which eventually leads to a run on the banks. The result is A. Defaults, when the bank closes its doors and depositors lose their hard assets, and or B. Devaluations of the claims on money, which mean depositors get back less. In the third type of system, governments can create money and credit freely, which works for as long as people continue to have denke in the currency and fails when they no longer do. Throughout history, countries have transitioned across these different types of systems for logical reasons. When a country needs more money and credit than it currently has, whether to deal with debts, wars, or other problems, it naturally moves from Type 1 to Type 2, or Type 2 to Type 3, so that it has more ability to print money. Then creating too much money and debt depreciates their value, causing people to get out of holding debt and money as a storehold of wealth and move back into hard assets and other currencies. Since this typically takes place when there is wealth ICT and sometimes war, there is also typically a desire to get out of the country. Such countries need to re-establish denke in their currency as a storehold of wealth before they can restore their credit markets. The following diagram conveys these different transitions. There are many historical examples, from the Song dynasty in China to Weimar Germany, of countries making the full transition from constrained types of monetary systems to money, then back to a constrained currency as the currency hyperinflation. This big cycle typically plays out over something like 50 to 75 years. Its ending is characterized by a restructuring of debts and the monetary system itself. The abrupt parts of these restructurings, i.e., the periods of debt and currency crisis, typically happen quickly, lasting only a few months to up to 3 years, depending on how long it takes the government to act. However, their ripple effects can be long-lasting, for example, when a currency ceases to be a reserve currency. Within each of these currency regimes there are typically 2 to 4 big debt crises, i.e., big enough to cause banking crises and debt write-downs or devaluations of 30% or more, but not big enough to break the currency system. Because I have invested in many countries for nearly half a century, I have experienced dozens of them. They all run the same way, which I explain in greater depth in my book Principles for Navigating Big Debt Crises. In the next chapter, I will go into more detail on the causes of and risks associated with money changing its value, showing what has happened in the past, which is pretty shocking. You can read more of my perspective on this in several papers at. While borrowers are typically willing to pay interest, which is what gives lenders the incentive to lend, nowadays there are some debt assets that have negative interest rates, which is a weird story that we will explore later. Monetized means the central bank's creation of money to buy debt. By the way, please understand that these rough estimates of cycle times are just rough estimates, and to know where we are in these cycles we need to look more at the conditions than the amount of time. Some central banks have made acting on this temptation harder by separating themselves from the direct control of politicians, but virtually every central bank has to bail out their government at some point, so devaluations always happen. Chapter 4. The Changing Value of Money. This chapter examines the concepts introduced in the prior chapter in a more granular way to show you how consistent they are with the actual cases they are derived from. While we will get a bit more into the mechanics here than we did in Chapter 3, I have written this chapter in a way that should be accessible to the general reader and, at the same time, precise enough to satisfy the needs of skilled economists and investors. As previously explained, there is a real economy and there is a financial economy, and the two are closely entwined but different. Each has its own supply and demand dynamics. In this chapter we will focus on the supply and demand dynamics of the financial economy to explore what determines the value of money. Most people worry about whether their assets are going up or down. They rarely pay much attention to the value of their currency. Think about it. How worried are you about your currency declining? And how worried are you about how your stocks or your other assets are doing? If you are like most people, you are not nearly as aware of your currency risk as you need to be. So, let's explore currency risks. All currencies are devalued or die. Of the roughly 750 currencies that have existed since 1700, only about 20% remain, and all of them have been devalued. If you went back to 1850, as an example, the world's major currencies wouldn't look anything like the ones today. While the dollar, pound, and Swiss franc existed in 1850, the most important currencies of that era have died. In what is now Germany, you would have used the gulden or the thaler. There was no yen, so in Japan you might have used the koban or the ryo instead. In Italy you would have used one or more of 6 currencies. You would have used different currencies in Spain, China, and most other countries as well. Some were completely wiped out and replaced by entirely new currencies. Some were merged into currencies that replaced them. And some remain in existence but were devalued, like the British pound and the US dollar. What do they devalue against? The goal of printing money is to reduce debt burdens, so the most important thing for currencies to devalue against is debt. Debt is a promise to deliver money, so giving more money to those who need it lessens their debt burden. Where this newly created money and credit then now determines what happens next. In cases in which debt relief facilitates the flow of this money and credit into productivity and pro-TS for companies, real stock prices rise. When the creation of money so silently hurts the actual and prospective returns of cash and debt assets, it drives out of those assets and into inflation hedge assets like gold, commodities, inflation index bonds, and other currencies. This leads to a self-reinforcing decline in the value of money. At times when the central bank faces the choice between allowing real interest rates to rise to the detriment of the economy or preventing real interest rates from rising by printing money and buying those cash and debt assets, they will choose the second path. This reinforces the bad returns of holding cash and those debt assets. The later in the long-term debt cycle this happens, the greater the likelihood there will be a breakdown in the currency and monetary system. This breakdown is most likely to occur when the amounts of debt and money are already too large to be turned into real value for the amounts of goods and services they are claims on. The level of real interest rates that is low enough to save debtors from bankruptcy is below the level required for creditors to hold the debt as a viable storehold of wealth, and the normal central bank levers of allocating capital via interest rate changes, which I call Monetary Policy 1, or MP1, and are printing money and buying high-quality debt don't work. This turns monetary policy into a facilitator of a political system that allocates resources in an uneconomic way. There are systemically beneficial devaluations, and there are systemically destructive ones that damage the credit capital allocation system but are needed to wipe out debt in order to create a new monetary order. It's important to be able to tell the difference. To do that, I will start by showing how the values of currencies have changed in relation to both gold and consumer price index weighted baskets of goods and services. These are relevant comparisons because gold is the timeless and universal alternative currency, while money is meant to buy goods and services, so its buying power is of paramount importance. I will also touch on how a currency's value changes in relation to other currencies' debt, and in relation to stocks because they too can be storeholds of wealth. The picture that all these measures convey is broadly similar when a devaluation is big enough. Many other things are also alternative storeholds of wealth, but gold will make my point nicely. In relation to gold. This chart shows spot exchange rates of the three major reserve currencies in relation to gold since 1600. We will examine all of this in depth later. For now, I would like to focus on both the spot currency returns and the total returns of interest-earning cash in all the major currencies since 1850. As the next two charts show, devaluations typically occur fairly abruptly during debt crises that are separated by longer periods of prosperity and stability. I noted 6 devaluations, but of course there were many more of minor currencies. To properly compare the returns of holding cash in a currency to gold, we have to take into account the interest one would earn on cash. This chart shows the total return on cash in each major currency versus gold. Here are the most notable takeaways. Big devaluations are abrupt and episodic rather than evolutionary. Over the last 170 years, there were 6 time frames when really big devaluations of major currencies occurred. In the 1860s, during its Civil War, the U.S. suspended gold convertibility and printed paper money to help monetize war debts. Around the time the U.S. returned to its gold peg in the mid-1870s, a number of other countries joined the gold standard. Most currencies remained XCD against it until World War I. Major exceptions were Japan and Spain, which frequently suspended convertibility to support large-scale deficits. During World War I, warring countries ran enormous deficits that were funded by central banks printing and lending of money. Gold served as money in foreign transactions, as international trust was lacking. When the war ended, a new monetary order was created with gold and the winning country's currencies, which were tied to gold. Still, between 1919 and 1922, several European countries, especially those that lost the war, were forced to print and devalue their currencies. The German mark and German mark debt sank between 1920 and 1923. Some of the winners of the war also had debts that had to be devalued to create a new start. With debt, domestic political, and international geopolitical restructurings done, the 1920s boomed, particularly in the U.S., in aiding a debt bubble. The debt bubble burst in 1929, requiring central banks to print money and devalue it throughout the 1930s. More money printing and more money devaluations were required during World War II to fund military spending. In 1944-45, as the war ended, a new monetary system that linked the dollar to gold and other currencies to the dollar was created. The currencies and debts of Germany, Japan, and Italy, as well as those of China and a number of other countries, were quickly and totally destroyed, while those of most winners of the war were slowly but still substantially depreciated. This monetary system stayed in place until the late 1960s. In 1968-73, excessive spending and debt creation required breaking the dollar's link to gold because the claims on gold that were being turned in were far greater than the amount of gold available to redeem them. That led to a dollar-based monetary system, which allowed the big increase in dollar-denominated money and credit that fueled the inflation of the 1970s and led to the debt crisis of the 1980s. Since 2000, the value of money has fallen in relation to the value of gold due to money and credit creation and because interest rates have been low in relation to inflation rates. Because the monetary system has been freeloading, it hasn't experienced the abrupt breaks it did in the past. The devaluation has been more gradual and continuous. Low, and in some cases negative, interest rates have not provided compensation for the increasing amount of money and credit and the resulting inflation. Now let's take a closer look at these events. The returns from holding currencies were generally pro-table between 1850 and 1913 relative to the returns from holding gold. Most currencies were able to remain XCD against gold or silver, and lending and borrowing worked well for those who did it. That prosperous period is called the Second Industrial Revolution, when borrowers turned the money they borrowed into earnings that allowed their debts to be paid back at high interest rates. Times were turbulent nevertheless. For example, in the early 1900s in the U.S., a debt-enhanced speculative boom in stocks grew overextended, causing a banking and brokerage crisis. That led to the Panic of 1907, at the same time that the large wealth gap and other social issues were causing political tensions. Capitalism was challenged, and taxes started to rise to fund the wealth redistribution process. Both the Federal Reserve and the U.S. federal income tax were instituted in 1913. Though a world away, China was impacted by the same dynamic. A stock market bubble led by rubber production stocks burst in 1910, causing the crash that some have described as a factor in the debt-money economic downswing that brought about the end of Imperial China. But throughout most of that period, Type II monetary systems remained in place in most countries, and the holders of those notes got paid good interest rates without having their currencies devalued. The big exceptions were the U.S. devaluation to finance its Civil War debts in the 1860s, the frequent devaluations of Spain's currency due to its weakness as a global power, and the sharp devaluations in Japan's currency due to its remaining on a silver-linked standard until the 1890s, while silver prices were falling relative to gold. When World War I began in 1914, countries borrowed a lot to fund it. This led to the late debt cycle breakdowns and devaluations that came when war debts had to be wiped out, actively destroying the monetary systems of the war's losers. The Paris Peace Conference that ended the war in 1918 attempted to institute a new international order around the League of Nations. But those efforts at cooperation could not forestall the debt crises and monetary instability caused by the huge war indemnities that were placed on the defeated powers, as well as the large war debts that the victorious Allied powers owed each other. Germany suffered a complete wipeout of the value of money and credit, which led to the most iconic hyperinflation in history during the Weimar Republic. The Spanish flu pandemic also occurred during the period, beginning in 1918 and ending in 1920. With the exception of the U.S., virtually every country devalued its currency because they had to monetize some of their war debts. Had they not done so, they wouldn't have been able to compete in world markets with the countries that did. China's silver-based currency rallied sharply relative to gold near the end of the war as silver prices rose, and then mechanically devalued as silver prices fell sharply amid the post-war deflation in the U.S. That period of war and devaluation that established the New World Order in 1918 was followed by an extended and productive period of economic prosperity, particularly in the U.S., known as the Roaring Twenties. Like all such periods, it led to big debt and asset bubbles and large wealth gaps. Different versions of the same thing happened during the 1930s. Between 1930 and 1933, a global debt crisis caused economic contractions that led to money printing and competitive devaluations in virtually every country, eroding the value of money moving into World War II. Conflicts over wealth within countries led to greater conflicts between them. All the warring countries built up war debts while the U.S. gained a lot of wealth in the form of gold during the war. Then, after the war, the value of money and debt was completely wiped out for the losers as well as for China, and was severely devalued for the UK and France, even though they were among the winners. A new world order and a period of prosperity followed the war. We won't examine it, other than to mention that the excessive borrowing that took place set in motion the next big devaluation, which happened between 1968 and 1973. By the mid-1950s, the dollar and the Swiss franc were the only currencies worth even half of their 1850s exchange rate. As shown in the following chart, the downward pressure on currencies and upward pressure on gold started in 1968. On August 15, 1971, President Nixon ended the Bretton Woods monetary system, devaluing the dollar and leaving the monetary system in which the dollar was backed by gold and instituting a monetary system. I will cover this episode in more detail in Chapter 11. Since 2000, we have seen a more gradual and orderly loss of total return in currencies when measured in gold, consistent with the broad fall in real rates across countries. In summary, the average annual return of interest-earning cash currency between 1850 and the present was 1.2%, which was a bit higher than the average real return of holding gold, which was 0.9%, though there were huge differences in returns at various periods of time and in various countries. You would have received a positive real return for holding bills in about half of the countries during that period and a negative real return in the other half. In the case of Germany, you would have been totally wiped out twice. most of the real returns from holding interest-earning cash currency would have come in the periods of prosperity, when most countries were on gold standards that they adhered to. The real return for bills since 1912 has been minus 0.1%. The real return of gold during this era has been 1.6%. You would only have made a positive real return holding interest-earning cash currency in about half of the countries during this era, and you would have lost meaningfully in the rest. Currency and gold real returns of major countries since 1850. Real returns and data for Switzerland is since 1851, data for Germany, Spain, and Italy is since 1870, data for Japan is since 1882, data for China is since 1926. Average return doesn't include China. The next chart shows the real returns from holding gold between 1850 and the present. From 1850 to 1971, gold returned an amount that roughly equaled the amount of money lost to a nation on average, though there were big variations around that average both across countries and across time, e.g., the 1930s currency devaluations and the World War II era devaluations of money that were part of the formation of the Bretton Woods monetary system in 1944. After the war, gold stayed steady in price across most countries, while money and credit expanded until 1971. Then, in 1971, there was a shift from a Type II monetary system to a Type III monetary system. That delinking of currencies from gold gave central banks the unconstrained ability to create money and credit. That led to high inflation and low real interest rates, which led to the big appreciation in the real gold price until 1980-81, when interest rates were raised significantly above the inflation rate, leading currencies to strengthen and gold to fall until 2000. That is when central banks pushed interest rates down relative to inflation rates and, when they couldn't push rates any lower by normal means, printed money and bought financial assets, which supported gold prices. The value of currencies in relation to goods and services. Thus far we have looked at the market values of currencies in relation to the market value of gold. That raises the question as to whether gold is an appropriate gauge of value. The next chart shows the value of interest-earning currency in terms of the consumer price index baskets of goods and services in those currencies, reacting their changes in buying power. As can be clearly seen, the two world wars were very bad and there have been ups and downs in the years since. For about half of the currencies, interest-earning cash provided a return above the rate of inflation. For the other half it provided negative real returns. In all cases, there were big and roughly 10-year-long swings around those averages. In other words, history has shown that there are very large risks in holding interest-earning cash currency as a storehold of wealth, especially late in debt cycles. The patterns of countries devaluing and losing their reserve currency status. A currency devaluing and a currency losing its reserve currency status aren't necessarily the same, though both are caused by debt crises. The loss of reserve currency status is a product of chronic large devaluations. As previously explained, increasing the supply of money and credit reduces the value of money and credit. This is bad for holders of money and credit but a relief to debtors. When this debt relief allows money and credit to flow into productivity and pro-TS for companies, real stock prices rise. But it can also damage the actual and prospective returns of cash and debt assets enough to drive people out of them and into inflation hedge assets and other currencies. The central bank then prints money and buys cash and debt assets, which reinforces the bad returns of holding them. The later in the long-term debt cycle this happens, the greater the likelihood that there will be a breakdown in the currency and monetary system. Policy makers and investors must be able to tell the difference between systemically beneficial devaluations and systemically destructive ones. What do these devaluations have in common? All the economies in the major cases that we examine in depth in Part 2 experienced a classic, run, dynamic, in which there were more claims on the central bank than there was hard currency available to satisfy them. That hard currency was typically gold, though. It was US dollars for the UK reserve currency declined because at that time the pound was linked to the dollar. Net central bank reserves start falling prior to the actual devaluation, in some cases years ahead. It's also worth noting that in several cases countries suspended convertibility before the actual devaluation of the exchange rate. The UK did this in 1947 and ahead of the 1949 devaluation, and the US did it in 1971. The run on the currency and the devaluations typically occur alongside significant debt problems, often related to wartime spending, which put pressure on the central bank to print. The worst situations are when countries lose wars. That typically leads to the total collapse and restructuring of their currencies and their economies. However, winners of wars that end up with debts much larger than their assets and reduced competitiveness also lose their reserve currency status, though more gradually. Typically, central banks initially respond by letting short-term rates rise, but that is too economically painful, so they quickly capitulate and increase the supply of money. After the money devalues, they typically cut rates. Outcomes diverge significantly across the cases, with a key variable being how much economic and military power the country retains at the time of the devaluation. The more it has, the more willing savers are to continue holding their money there. More specifically for the major reserve currencies, for the Dutch, the collapse of the guilder was massive and relatively quick. It took place over less than a decade, with the actual circulation of guilders falling swiftly by the end of the Fourth Anglo-Dutch War in 1784. The collapse came as the Netherlands entered a steep decline as a world power, RST losing to the British and subsequently facing invasion from France. For the UK, the decline was more gradual. It took 2 devaluations before it fully lost its reserve currency status after Bretton Woods, though it experienced periodic balance of payments strains over the intervening period. Many who held reserves in pounds continued to do so because of political pressures, and their assets significantly underperformed U.S. assets during the same time. In the case of the U.S., there were 2 big abrupt devaluations and more gradual devaluations against gold since 2000, but they haven't cost the U.S. its reserve currency status. Typically, a country loses its reserve currency status when there is an already established loss of economic and political primacy to a rising rival, which creates a vulnerability, and there are large and growing debts monetized by the central bank printing money and buying government debt. This leads to a weakening of the currency in a self-reinforcing run that can't be stopped because the scale and balance of payments deficits are too great for any cutbacks to close. In Part 2, we will see the last 500 years of history as one continuous story of rises and declines of empires and the reasons for them, and you will see the same cause-ECT relationships driving the rises and declines. But RST we need to explore the big cycles of internal and external order disorder, which we will do in the next 2 chapters. Due to a lack of data, several charts in this chapter do not show China. Chapter 5. The big cycle of internal order and disorder. How people are with each other is the primary driver of the outcomes they get. Within countries there are systems or orders for governing how people are supposed to behave with each other. These systems and the actual behaviors of people operating within them produce consequences. In this chapter, we will explore the timeless and universal cause-ECT relationships that shape the internal orders and the behaviors that drive the shifts between periods of order and periods of disorder. Through my research, I saw how changes in internal orders and changes in the world order happen continuously and everywhere in similar and increasingly interconnected ways that out together as one all-encompassing story from the beginning of recorded time up to this moment. Seeing many interlinking cases evolve together helped me to discover the patterns that govern them and to imagine the future based on what I've learned. Most importantly, I saw how the constant struggle for wealth and power produced continuously evolving internal systems orders and external systems orders, and saw how these internal and external orders ECT each other, with the whole thing working like a perpetual motion machine that evolves while doing the same things over and over again for basically the same reasons. The biggest thing affecting most people in most countries through time is how people struggle to make, take, and distribute wealth and power, though they also struggle over other things, most importantly ideology and religion. I saw how these struggles happened in timeless and universal ways, and how these struggles had huge implications for all aspects of people's lives, starting with what happened with taxes, the economy, and how people were with each other through periods of boom and bust and peace and war, and how they unfolded in cyclical ways, like the tide coming in and out. I saw that when these struggles took the form of healthy competition that encouraged human energy to be put into productive activities, they produced productive internal orders and prosperous times, and when those energies took the form of destructive internal guiding, they produced internal disorder and painfully decultured times. I saw why the swings between productive order and destructive disorder typically evolved in cycles driven by logical cause-ECT relationships, and how they happened in all countries for mostly the same reasons. I saw that those that rose to achieve greatness did so because of a confluence of key forces coming together to produce that greatness, and those that declined did so because these forces dissipated. At the time of this writing, there is growing disorder in a number of leading countries around the world, most importantly in the United States. I wanted to put that disorder into perspective, so I built indices of it, and conducted the research I am sharing in this chapter. Because how the U.S. handles its disorder will have profound implications for Americans, others around the world, and most economies and markets. In this chapter 1 I'm focusing more on the U.S. than on other countries. This Simply Ed chart shows approximately where the U.S. and China are within the archetypical big cycle, as measured by the previously described determinants. The U.S. is in the stage, which I call Stage 5, when there are bad financial conditions and intensifying con-ICT. At the same time, the leading empire still has other great strengths that are declining on a relative basis. Classically, this stage comes after periods of great excesses in spending and debt, and the widening of wealth and political gaps, and before there are revolutions and civil wars. To be clear, I am not saying that the United States or other countries are inevitably headed into a period of greater decline or more internal and external con-ICT. However, I am saying that it is important to watch the markers in order to understand both what is happening and the full range of possibilities for the period ahead. In this chapter, I explore those markers by drawing on the lessons from analogous historical cases. The 6 stages of the internal cycle. Internal orders typically change through a relatively standard sequence of stages, like the progression of a disease. By looking at their symptoms, we can tell which stages countries are in. For example, just as Stage 3 cancer is different from Stage 4 cancer in ways denoted by different conditions that exist and have come about as a result of things that happened in prior stages, the same is true for the different stages of the big internal cycle. Like diseases, different conditions warrant different actions to address them, and they produce a different range of probabilities that those actions will lead to. For example, an old, unhealthy set of circumstances produces a range of possibilities and warrants different actions than a young, healthy set. As with cancer, it is best to stop the progress before getting into the later stages. From studying history, it appears to me that the stages of the archetypical cycle from internal order to internal disorder and back are as follows. Stage 1, when the new order begins and the new leadership consolidates power, which leads to. Stage 2, when the resource allocation systems and government bureaucracies are built and renewed, which if done well leads to. Stage 3, when there is peace and prosperity, which leads to. Stage 4. When there are great excesses in spending and debt, and the widening of wealth and political gaps, which leads to. Stage 5, when there are very bad financial conditions and intense con-ICT, which leads to. Stage 6, when there are civil wars, revolutions, which leads to. Stage 1, which leads to Stage 2, etc., with the whole cycle happening over again. Each stage presents a different set of conditions that the people facing them have to deal with. Some of these circumstances are much more difficult than others to resolve. For example, early in the long-term debt cycle, when there is plenty of capacity for governments to create debt to finance spending, it is easier to deal with the circumstances at hand than late in the long-term debt cycle when there is little or no capacity to create money and credit to finance spending. For these reasons, the range of possible paths forward and the challenges that leaders face depend on where in the cycle a country is. These different stages present different challenges that require different qualities, understandings, and skills from leaders in order to actively deal with them. How will those facing these circumstances, e.g., you facing your circumstances and our leaders facing our collective circumstances, understand and adapt to them? How good or bad the outcomes will be within the range of possibilities that exist given the circumstances. Different cultures have established different ways of approaching these circumstances. Those leaders and cultures who understand them and can adapt to their circumstances will produce much better outcomes than those who don't. That is where timeless and universal principles come in. While the length of time spent in each of these stages can vary a lot, the evolution through them generally takes 100 years, give or take a lot, and with big undulations within the cycle. Like evolution in general, the evolution of internal orders occurs in a cyclical way in which one stage typically leads to the next through a progression of stages that repeat and, in the process, evolve to higher levels of development. For example, stage 1 normally comes after stage 6, which leads to the next stage, and so on up to stage 3, which gets overdone in stages 4 and 5 and so on, leading to the next new order. That happens over and over again in an upward evolving way. Again, that archetypical cycle typically takes 100 years, give or take a lot. Within each cycle there are similar, smaller cycles. For example, there is a short-term debt cycle that leads to bubbles and recessions that come along roughly every 8 years. There are political cycles that move political control between the right and the left that come along with roughly equal frequency, etc. Every country is now going through them, and many of them are in de-arrent stages. For example, China and India are in very de-arrent stages than the United States and most European countries. Which stages countries are in versus other countries affects the relations between countries and is the primary determinant of the world order. We will explore all of this in the last chapter of this book. The cycle's archetypical evolution transpires as shown in the following diagram. That is the complete internal order cycle. But of course the cycle repeats, with new leaders replacing the old ones and the whole cycle beginning again. How quickly a nation is able to rebuild and achieve new heights of prosperity depends on 1. How severe the civil war revolution that ended the prior cycle was, and 2. How competent the leaders of the new cycle are at establishing the things required for success. These cycles have taken place for as long as there has been recorded history, so many cycles are linked together, and they are upward sloping because of evolutionary gains that are made over time. To see this at the country level, let's look at China. The following chart shows my estimates of China's absolute powers and its cumulative big cycles going back to around the year 600. This is an ultra-simplified chart. I am presenting it in this way so you can see how this evolution transpired from the 30,000-foot level. The next chart shows China's relative powers. The differences between the charts are due to the fact that the RST1 shows the absolute level of power while the second one shows the level of power relative to other empires. Since de-arrent countries are typically in de-arrent stages of the cycle and since they take wealth and global political power from each other, some countries are rising while others are declining, so the whole is less volatile than any one country. In other words, the de-arrences have had a diversifying EECT that has made the whole world's evolution smoother than that of any individual country. That is shown in the next chart, which is an update to the global real GDP chart I showed you in Chapter 1. This chart is not a curative representation. It is literally the best estimate we have of real GDP per capita. Embedded in this chart are the rises and falls of major empires, numerous wars, and numerous booms and busts, all of which are called out. These events don't show up at the global level because they diversify each other, and because they are small relative to the big trends, even though they are huge from the perspective of the people living through them. To reiterate, the curative pictures of the archetypical 6-stage cycle I just painted are simply versions of what really happens. I wanted to show you a simply version that conveys the essence of the stages and then descend into the details. While the cycle by and large progresses as I described, it doesn't always progress exactly as I described. For example, like the stages of a disease, being in one stage doesn't mean that the progression to the next stage is inevitable. But it does tell us a lot that is very valuable. As with a disease, certain symptoms are clearly exhibited that allow one to identify which stage in the cycle one is in, and being in that stage signifies the risks and ways of treating the situation that are essential to know and are different from those that exist in different stages. For example, being in stage 5 means that certain conditions exist that make it more likely that the cycle will progress to stage 6 than if it were in stage 4 with stage 4 conditions. By having clear and objective markers to identify which stage each country is in, and by having an understanding of the cause-EECT relationships that produce changes, one can better know the range of possibilities and position oneself accordingly, though one can never get them exactly right. As an example, we made an index of the number of economic red ages that have existed at different times in history, including measures of high inequality, high debt and deficits, innovation, and bad growth, to show how indicative they are of subsequent civil wars and revolutions. The following chart shows the estimated likelihood of a Civil War-type CON-ICT based on the number of red AGS. Based on what we have seen in the past, we estimate that when there are 60–80% of the red AGS present, there is around a 1 in 6 chance of severe internal CON-ICT. When lots of these conditions are in place, there is around a 1 in 3 chance of a civil war or revolution, so not very probable but still too probable for comfort. The US is in the 60–80% bucket today. While I won't take you through all of the factors in each stage and their various configurations, I will outline the forces and milestones to pay most attention to in each stage, with a special emphasis on the current state of disorder in the United States and how things are progressing. Delving into the 6 stages of the cycle. We will now delve into what the archetypical 6 stages look like in greater detail so we can identify them easily when we see them, and so we can better imagine what might come next. Stage 1. When the new order begins and the new leadership consolidates power. To GHT a civil war or to have a revolution, even a peaceful one, is to have a great CON-ICT in which one side wins and the other side loses and the country suffers damages. Stage 1 is what follows the war. It is a time when the winners gain control and the losers must submit. While the winners were strong enough to win, at this RST stage of the new order, they must also be wise enough to consolidate power and rebuild the country. After winning power, the new leaders typically mop up the remaining opposition and GHT among themselves for power. In fact, one might say that revolutions typically come in 2 parts. The RST part is the GHT to bring down the established leaders and systems, and the second part is the GHT to remove those who were loyal to the former leaders and the GHT for power among those who won. I will call the second part purges, and touch on them in this section. These consolidation of power purge periods range widely in form and severity, depending on the degrees of CON-ICT between the new leaders and their opposition, the amount of CON-ICT between the new leaders themselves, and the levels of development of the various government departments and bureaucracies that they are inheriting. This is the stage when, in some cases, the remaining opposition is killed or imprisoned so that the new leaders are assured that their enemies won't come back guiding. It is also when those revolutionaries who are on the winning side of the revolution GHT against each other for power. This stage has happened after virtually all civil wars revolutions. Its intensity varies, usually in proportion to the intensity of the Civil War revolution that preceded this stage. At its worst, this post-revolution guiding to consolidate power produced some of the most brutal periods in a given country's history, e.g., the post-1789 French Revolution period called the Reign of Terror, the post-1917 Russian Revolution period called the Red Terror, the post-1949 Chinese Civil War period called the Anti-Rightist Campaign, etc. In some cases these purges happened a single time right after the revolution, while in other cases they came and went episodically over decades. These purges are done to consolidate power and persecute perceived ideological enemies or enemies of the state, and they are sometimes more brutal than the revolution itself. At their best, and if conditions allow because the basic system and respect for it is maintained, they're like the period after the U.S. Civil War or during the peaceful Roosevelt Revolution of the 1930s. During this stage the leaders who do best are consolidators of power. They typically have qualities similar to those who did best in the revolution in the prior stage, as they are strong, smart guiders who are willing and able to win at all costs. But in this stage they have to be much more politically astute because the enemies are much less apparent. Tang Emperor Taizong and Rome's Caesar Augustus excelled at this stage. More recently, leaders such as the U.S. Founding Fathers, France's Napoleon, and Germany's Otto von Bismarck also exemplify how to actively move from the war period to the rebuilding period. This stage is over when the new authorities are clear and everyone is sick of the guiding and is well into the rebuilding. Stage 2, when resource allocation systems and government bureaucracies are built and refined. I call this phase early prosperity, because it is typically the beginning of a peaceful and prosperous period. After the new leaders have torn down the old order and consolidated power, or overlapping with that time, the new leaders have to start building a new system to better allocate resources. This is the stage when system and institution building are of paramount importance. What is required is designing and creating a system that leads to people rowing in the same direction in pursuit of similar goals, with respect for rules and laws, and putting together an effective resource allocation system that leads to rapidly improving productivity that benefits most people. This redesigning and rebuilding period has to be done even after lost wars because rebuilding still must occur. Examples of countries being in this stage include the United States in the 15 years after it declared independence in 1776, the early Napoleonic era immediately after Napoleon grabbed power in a coup at the end of the French Revolution in 1799, the early Japanese Meiji Restoration period immediately after the political revolution in 1868, the post-war periods in Japan, Germany, and most countries in the late 1940s through most of the 1950s, the post-Civil War period in China, and Russia after the breakup of the Soviet Union. A timeless and universal principle to keep in mind during this stage is that to be successful, the system has to produce prosperity for most people, especially the large.